Of course, the world realizes that with those two elections, you cannot trust the renminbi and you cannot trust China. You cannot trust the ruble being any health, and you cannot trust Russia. And for that matter, the whole world is reorganizing even more so around U.S. in every way. And the U.S. is going to benefit from that in a big way. And I bring those two elections because I'm arguing that the way the biggest countries in the U.S., whether it's the S&P 500 or the Russell 3000, are taking advantage of that global reorganization.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz, your host. And with us today is somebody I met at the Rick Rule Symposium, and you're going to like him a lot. His name is Professor Joel Litman, and he is Chief Investment Strategist at Altimetry, which I like that name, by the way. That is great branding. Gives you a really good feel of what you do. And, he's got some views on what's happening now on investing. He's a visionary, a forward thinker. Joel, we were talking pre-call about the internet boom and how your view was, hey, in 5 years, if you're not a .com, you're dead. And here we are, 20 years later, everybody's a .com. So with that introduction, great to have you on. Tell us first, election is on everybody's brain. Now, you and I have been through a lot of election cycles. It's kind of like that joke you just told me. If two lawyers jump off the cliff, one's personal injury and one's a corporate lawyer, who's going to win? And the answer is, everybody. Well, in the case of political campaigns, you want to pick a loser. The American public has consistently been the loser in every election cycle, with maybe one exception during Reagan, since I've been voting. So with that word, a cautionary statement, what is going on with the election and the markets? I don't care about the particular candidates, their positions, whatever. All I care about is impact upon the market at present and in the future.
Well, I'd say the two most important elections for the health of the U.S. economy and the U.S. stock market already happened. First one was Xi Jinping for life in China, and the second was Putin for life in Russia. With that, it solidified that you cannot trust Russia or China as doing business. Everyone knows, and you're looking at a reglobalizing the world around U.S. law, U.S. sovereignty, U.S. respect for other countries' sovereignty, unlike China and Russia, respect for the almighty dollar, the protection of shipping lanes, the financial system, that for all its problems and all these issues, who would you rather deal with or trust? Court of law in the United States or the court of law in China, where no company outside China has ever once successfully sued a company inside China, with the exception of Michael Jordan, who I think won like $50,000, $60,000 after they stole $1 billion or more of revenues of Air Jordan without paying a single dime to him for use. And so the court was like, yeah, you win. But talk about a Pyrrhic victory. Yeah, talk about a Pyrrhic victory. So of course, the world realizes that with those two elections, you cannot trust the renminbi and you cannot trust China. You cannot trust the ruble being any health, and you cannot trust Russia. And for that matter, the whole world is reorganizing even more so around U.S. in every way. And the U.S. is going to benefit from that in a big way. And I bring those two elections because I'm arguing that the way the biggest countries in the U.S., whether it's the S&P 500 or the Russell 3000, are taking advantage of that global reorganization, the speed with which they've become less dependent on China and non-dependent on Russia. There's some black market stuff going on, but for the most part, pulling out and saying, I want to protect my IP, I want to protect our work. And then you look at the tariffs and the things that have been put in, not just the tariffs, but it was Trump that originally said, no, we're not going to allow our best super chips to be able to go, our best technology and chips to go to China. And the truth is the Biden administration doubled down on it. Trump put in tariffs on China, and the Biden administration has doubled down on that. The Biden administration at the beginning, they killed the Keystone Pipeline, but then they went and issued more construction and building permits for oil and gas related projects than even Trump did. So in many ways, you just have to say, well, if Trump wins, we know what his policies are, and they're going to be good for the U.S. stock market and the U.S. economy overall. I think that's easy to understand. On social topics or whatever else, that's a different story. You can vote who you want. If you're talking about what's good for the stock market and what's good for businesses, there's your answer, right? Now, if Kamala wins, if she wins, and I don't think she will because the electoral, if not forgetting about the polls, from an electoral map standpoint, she has a supermajority in certain states, but not enough to carry so many of the states. And so let's say, though, that Kamala wins. I think that she is so concerned with popularity and she's so concerned of doing what will be right that she will go center, or at least will not have Congress's backing to continue to be left of Bernie Sanders, because she has been left of Bernie Sanders, let's face it, as a senator, right? But
doesn't get any more left than that, right?
Right. But as part of the Biden administration in the last 3 years, they did not raise taxes like people thought they would. We still have the corporate tax cuts in place, which have been a big boon. The U.S. was one of the highest corporate taxpayers, which the Laffer curve, that's very, very bad for the business. And you bring it down to something, almost half, at least 40% cut, from 30 something to 20, 21%. And you have a situation with U.S. companies that they can compete, in a much, much bigger level, and not just compete, but dominate. Because once you have that, all the U.S. innovation and the R&D that's going on, which is bigger than the rest of the world combined, right? So when you think of these things, I don't know that this election, I don't believe Kamala Harris can go anywhere near as left as she has been as a senator. And Trump, we know, will be very pro U.S. economy, U.S. markets, will be very good. Either way, I think the S&P 500 is still going to continue to do well. I think it'll do, better under Trump than it would have Kamala Harris, simply because the uncertainty of what Kamala Harris might do. But at the end of the day, my guess is she probably goes more center and even center right, the way Biden has on so many China tariffs, economic policy, whatever else. That I think you're going to find a very, very healthy U.S. stock market over the next 4, 5, 10 years, and still a good place to, for a passive investor to say, if I don't want to spend any time, I'll just put all my money in the S&P 500 that I won't need for 5 or 10 years, all my 401k in the S&P 500, all of my IRA in the S&P 500. That is a very, very smart move for anybody now, regardless what happens with these elections.
Yeah. So interestingly, talking about markets, to me, I think the market has already put in its prediction that Trump is going to win. I don't know who's going to win, honestly. I called 2016. I called 2020. This one, my gut says Trump, but I really don't know. And I don't know in the scheme of things. I think there's definitely important differences. But so we had this little mini crash 3 weeks ago. And, hey, my portfolio was still ahead even after the crash finished. As of today, I'm right back exactly where I started from. And so what was the significance, if any, of that little crash? And what's correction to a lot of you out there, so I'm not minimizing it.
Well, I mean, if you were, sitting on, NVIDIA and a bunch of the other names, then you really got hit hard. But if you're buying, the S&P 500, you're being long the S&P 500, you're right. You're still up 17+% for the year, even including the quote unquote crash we experienced. The fact of the matter is U.S. corporate earnings on a uniform basis, not the gap accounting. You cannot trust the as-reported numbers of this stuff on CNBC or Bloomberg all day. Those numbers are nonsense. But if you convert to uniform accounting the way the biggest investors, the way my clients, right, my readers, 230 of the biggest 300 money managers in the world look at things, they say, well, I'm not going to look at those gap accounting numbers. I'm going to convert to uniform. You do see that uniform earnings is up this year. It is, again, getting to record highs. And some people say, well, the stock market's a record high. I'm like, well, earnings is a record high. So don't they go together? Right? And the expectation that earnings will continue to grow into 2025, again, for the S&P 500 is very, very strong across the board. I don't see any reason to not believe that. So the stock market may take corrections, but to have thought that this was the beginning of a bear market, it was just not supportable by any bear market we've ever experienced in history. Valuation alone never sends a market to a bear market. True bear markets occur because of credit crises. It's always been that way. You can go back hundreds and hundreds of years. And while there are credit issues going on with the banks right now, right, and we have had a few bank failures and what have you, and we're probably going to have a few more, given what's happened with commercial real estate and how heavily banks are loaned, are loaning money or have loaned money into commercial real estate. We're going to still have some particular office, right, is going to still be very, very, very bad. But if you can access public debt markets, it's a very, very, very healthy environment. And you've never had a long-term, deep equity bear market in the United States and in most of the developed world without an accompanying balance sheet crisis in terms of the debt on the books of the companies. It does not exist. So any rollover in the market is a correction. We have to keep looking to say, are there any fissures in credit? But right now there aren't for the biggest companies in the U.S. And so the biggest companies have a correction. That's a buying opportunity, right? And we'd still be very, very bullish for the next 5 to 10 years for the S&P 500.
So in my 40 some odd years of investing, there's one rule that I have found to be a virtual absolute truth. I've never seen it not work. And that is stocks climb on a wall of worry.
Yes. Always. Yeah. Like coming out of a bear. If you remember in 2009, early 2000, the single probably best time to invest in the stock market, one of the three best times, at least in my lifetime at 55 years old, probably the three best times to invest in the stock market was March of 2009, April 2009. And the headlines then, kind of the Wall Street Journal and everyone else, was the stock market has fallen 40, 50%. It could fall another 40, 50%. At exactly the time you could have been buying. And it stayed that way for the next 2 to 3 years. Like, oh no, it's going to test financial Armageddon. We're still not out of the woods. That wall of worry. And the stock market recovered in 2.5 years? All the losses from the peak of 07 to 2009 recovered in just 2.5 years. And then had you held on another 4, 5, 6 years, you would already been doing, unbelievably better than you would have thought with a purely passive investment strategy of just buy S&P 500.
Hey, what about April of this year? Everybody's saying recession, and it takes off again, and everybody's surprised, right?
Well, at the end of the day, you're buying the S&P 500. You're not buying the U.S. economy. And the idea that the stock market and the U.S. economy are the same thing is how many investors lose money and stay out when they shouldn't. Almost half of the revenue of the U.S. S&P 500 is non-U.S. And the U.S. management teams have been very smart about picking and choosing where to go around the world to generate that extra 40 to 50% of revenue on top of the revenue they generate, like locally in domestic markets. The other thing that they've been very good about is saying we're going to keep our balance sheets safe. The balance sheets of the S&P 500 are unbelievably well built, meaning, yes, they have more debt than ever. The structure of their payment and the low interest rates they have it at over the last 3, 4, 5 years is so low that even when they refi it, call it 5%, it's still some of the cheapest rates in all of history, to be perfectly honest, which means they're safe companies, which means no chance of a massive bear market. I was saying earlier that even in 2000, when people say, well, what about the tech bubble? I don't know if people realize there was a massive credit crisis in 2000.
Yeah.
The private markets were dried up completely, right? Banks were in trouble, but no one reports it. They just said, oh, it was a tech bubble that burst earlier. No, it was a tech bubble. Yes, it was expensive. However, with a massive credit crisis on the balance sheets of U.S. corporations, and that's when you get to bear markets. So, yes, we could have a recession in the United States. We might be in one right now. We don't know. The SOM rule, and looking at unemployment would say we're probably, unemployment versus averages, the SAHM SOM rule would say we're probably in a recession right now. It's possible. That doesn't mean that U.S. companies can't still produce record profits and people won't still around the world invest in those companies regardless of what's happening, if there is some kind of rolling recession or pockets of recession or an outright 2 quarters of negative GDP in the United States.
Yeah. Couldn't agree with you more. And yeah, it's just interesting that people have never accepted that truism, because what it says is go against your emotions. And, like Warren Buffett, when there's blood in the streets, that's when you want to be out there. And then when times are really good everything, it can't ever be bad again. That's when you want to get out, right?
Right. Well, that plus a credit crisis. So euphoria by itself does not tell you when to sell the market. It's euphoria plus a credit crisis on the balance sheets of the companies that you're buying. You can have a credit crisis in student loans, right? You can have a credit crisis with U.S. debt. That's not the same thing. Yeah, but you're not buying the U.S. stocks. You're buying the U.S. companies who are making money all over the world. And in so doing, right, the earnings that you're getting there attracts global investors from all over the world. It still does. U.S. market cap is more than the entire rest of the world combined, and rightly so, because U.S. corporate profits. Now you have to do uniform accounting. We have a database of 32,000 companies globally. They all have different accounting regimes. Chinese accounting standards are different from German accounting standards, are different from UK accounting standards. We put them all in the same playing field, all 32,000 companies. So you get a true apples to apples comparison. And U.S. companies, the United States corporations, generate more in corporate profit than the entire rest of the world's companies combined, which is why U.S. stock market is bigger than the entire rest of the world combined. They line up. It's not a bubble. It's not a, oh my goodness. Now, if there's a correction, all right, there could be, right? There could be. I'm just saying that I'd probably be a buyer, right? If we see another decent correction.
Yeah. I'm thinking, corrections are just normal. For the most part, Joel, what causes a correction?
Well, it's, enough bad news and the things that it caused this one, right? Where trouble with the current president dropping out of the race or being outright sick or getting COVID, and then a horrible assassination attempt on Trump that, is still, people are still learning what on earth happened there and what's really going on. Right. And could there be more of these issues, meaning is safety, anything like that, of course, is going to give you a reason when the stock market had reached such highs and such momentum. But falling 5% is just enough for people to go, oh, yeah, but let me go buy back in. Because at the end of the day, the corporate earnings are not rolling over. And as long as those earnings keep going up, well, why won't the stocks? Right. And with very, very safe balance sheets from a credit standpoint. Unbelievably safe. Really amazing that the CFO should get pause for that.
One thing I learned in my investing is that you may love or hate big companies, but big companies are always, in the long run, way more stable than smaller companies. And I've had these magical small caps. Some of them have done really well, but a lot of them, I should say, not most, a lot have blown up. It's unusual for a company in the S&P 500 to just walk in one day and the thing blows up for no reason that anyone could figure out.
Yes, highly unusual. And the size of the companies, their ability to access capital from a number of different places that a small $5 million, $10 million, $100 million business can't, right? The ability to access the public debt markets and to get investors in debt from all over the world, not just in equity, gives flexibility to large companies that does allow them to weather the storms in a way. And so, again, for purely passive investing, S&P 500 the next 5-10 years is going to do very, 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 very well. Right. Very well.
So a while ago, basically, the SEC kind of banned the Chinese companies from our stock markets. Why would they do such a thing, Joel?
Well, I think they were like 5 years late in doing it. Be 8 years late, never got
allowed, right?
It's because we have an international database. One of the things we saw was companies in China that were filing financials with the New York Stock Exchange or the NASDAQ or whatever, or with the SEC, filing with the SEC. And the numbers were different than the numbers that they were filing with SEIC, the SEC of China. So one thing we found that's so interesting is that Chinese companies are perfectly willing to lie through their teeth about their revenues, their profits, you name it, when they file with the U.S. But they're unbelievably scared of filing in Chinese with a Chinese authority because they're worried about getting disappeared for the rest of their lives. So there is, because you do have these anti-corruption campaigns within China that sweep through and suddenly people just go missing. And so when you get the financials directly from China, from the SAIC, and you start looking at those numbers and adding them up, you find that one out of 3 companies in China, public listed companies, is at risk of true bankruptcy or default on their loans, balance sheets that are uglier than anything you saw in the 1930s in the United States. What China's going to go through the next 2 decades is worse than the Great Depression. Yeah. And yet in the U.S., I'd say, if we looked at the 6,000 companies we cover in the U.S., maybe 1% have a risk of default. One. Whereas in China, it's of 6,000 companies we cover in China, 33%, 34% have horrible, horrible balance sheets. So it's not just the Chinese government and municipalities. The individual Chinese companies have grossly over-levered, unbelievably. So it's going to be very, very bad for the Chinese economy for the next 20 years. 20 years. 20 years.
That's why debt is a four-letter word, because eventually all debts have to be handled, paid off, defaulted, liquidated, forgiven, renegotiated, whatever it is.
Yeah.
Deal with them.
And the world and foreign direct investment has collapsed to zero, if not negative at this point in China. Meaning not only is the net new investment falling, that there's enough divestitures and selling that you could argue foreign direct investment in China is now negative. So where are they going to get the extra money to do what you said, to renegotiate, to bail out, to whatever? They got one place to go, and it's the Chinese government. And even the Chinese government doesn't have the kind of money to bail out a third of Chinese companies, which is what our data is showing at this point. And it's terrible.
And that's part of the reason why markets in the U.S. have been so good, because that flight capital. Like, I realized the Chinese scam when I went to the Bahamas, and they were building this huge new development, all with Chinese money in Nassau. And I realized they weren't building. They said they were building it for Chinese gamblers to come visit. And I said, there is no way that Chinese gamblers are coming to the Bahamas. They're not into like beach vacations.
Yes.
They go to a casino, they stay in the casino, and you never see them until you carry them out and you send them home. And I said, oh, the beauty here is they're going to lose money. This place will never make money. And it's a way to drag money to legitimately launder money out of China into the West so they can.
Yeah.
And that's done. That's the whole belt, the bribe and rape initiative is all about taking money out of China, getting it out, because you're never safe there, no matter how high up in the government and the economy you are. Bring it to the U.S. and find a safe place for it relative.
And if you lose 20 to 50% in moving it, fine. That's the cost of moving it. And so you can have the companies, these Chinese companies, do those things and be losing money, but they're like, no, I'm not really losing because I've moved it out of renminbi, which is what every wealthy Chinese person is trying to do. Right now, one of the works that the Henley Partners did was that right now 13,000 multimillionaire families are leaving China every year. 13,000. So when you think of that and say, what's the average net worth of each of those Chinese families? 5 million to 20 million times 13,000 a year, right? Flying out of there because they're like, we do not want to stay for how bad it's going to be. That is one of the biggest signs. And where are they going? They're going to the U.S., they're going to Australia, they're going to Dubai if they can. They're going to Canada, right? Some to Portugal, Greece, right? Spain.
We'll take them.
Anywhere they get a golden visa, right? Anywhere they can get a golden visa and get out, because they know that they got to get out while the getting's good, right? Because it's going to be a bad 20 years for China's economy.
For the next 10 years, you just put your money in the S&P and let it ride?
For a purely passive investor, yeah. I mean, if you want to just sleep at night and do nothing, well, keep taking that $1,000 every month out of your 401k and put it 100% into the S&P 500. There's no reason to be 50-50 bonds or 60-40 or some crazy thing like that. Not if you're not going to touch that money for 5 to 10 years. That's plenty of time to benefit from the volatility of the S&P, like losing 5% or 8% or 20%, right, during the pandemic, and then watch it recover. People are realizing in 2020, the stock market was net up.
Right.
In 2020 proper, the calendar year, the stock market was up, right? And people are like, oh, but there was a pandemic shutdown. And like, and still, the S&P 500. And then they had a banner year in 21, right? 22 did well, 23, a little bit softer market. And then this year, gangbusters. So, the idea that you can time which year, that's tough. Nobody can say. Nobody can say. But to be able to say for the next 5 to 10 years, yes. All right. U.S. equities.
All right. So one thing, we talk the companies, the stock market's doing well, whether the country is doing well or not. A lot of their profits, S&P 500, I don't remember, 35, 40% comes from overseas. Some companies, 60, 70%.
Yes.
The debt, the U.S. budget, the terminal state that it's in. Does that give you pause for worry or concern?
I mean, it will if Congress can't get a handle on themselves. But at this point, right now, no. The U.S. does not have a debt issue whatsoever. It's why that every time the U.S. says we're doing another round of treasuries, they get oversubscribed by people around the world who want dollar-denominated AAA interest. The idea that, I don't know, Fitch had the U.S. government AA. I'm like, if the U.S. isn't AAA, nobody is. So why even have the rating, right? No, the U.S. is still AAA. And the reason is, even at the higher interest rate levels, which are probably going to get cut, but let's say they don't get cut, right? We don't see even 2 rounds. So the U.S. is paying, what, 4.5%? Well, we can do the math, right? Let's do easy math. What's 5% of $30-something trillion? It's not hard to do that math and say, all right, a blend of 5%, some of it's still at 2%, some of it's still at 3%, is about $1 billion a year in debt service. $1 trillion a year in debt service for the U.S. Well, what does the U.S. generate in taxes every year? Because people are using this debt to GDP, and I'm like, why? No government uses GDP. They can't just take the GDP and pay off their debts. Why is debt to GDP the right measure? And this is an important point. The U.S., right, and every country in the world, their main form of revenue is taxes, right? They take their taxes. Sometimes they're 100%, like Russia right now is like 100% tax. All profits of oil and gas go to Russia, right, at this point. So it's effectively 100% tax on that industry. China does that with some of their industries too, where the state, right, gets the bulk of whatever profits. But the fact is, U.S. companies are generating so much in profit. I mentioned that. And if the U.S. companies can generate more profit than the rest of the world combined, that means the corporate tax revenue, even on a lower tax rate, right, is more.
Going up. Yeah.
Right. And so as that's coming in and at record levels, by the way, the Trump tax cuts that the New York Times and everyone said, oh my goodness, Trump is just giving a tax break and whatever else. U.S. companies today at a lower tax rate are paying more in taxes than they were at the higher tax rate just 4 or 5 years ago, right? Meaning the companies reinvested that money. They used it. It wasn't all dividends and share buybacks like the New York Times. If people were saying, oh, this is just a handout to the rich. No, the companies use it in R&D. They use it in innovation. They use it to buy other firms. They grew. They're now more profitable and paying far more in corporate tax today at a lower tax rate than they were to higher. So Art Laffer deserved the Presidential Medal of Honor that Trump gave him. He should get the Nobel Prize, but because it's so politically charged about taxation, whatever, and the Europeans love taxes so much, right? Because the politicians, they're like, oh, love their taxes. They're never going to give him a Nobel Prize, and he deserves it in economics like nobody in the last 20 years. Anyway, put all that together, and you have the U.S. generating more than what we call it next year, $5 trillion of taxes and $1 trillion of debt service. That's a no-brainer.
Mm-hmm.
That's easy. All right.
Okay. Well, hey, we appreciate your views here, and I guess the best place to find you is altimetry.com.
Yes, sir.
I just signed up myself on the list. The show notes in the link rather is in the show notes to this interview on financialsurvivalnetwork.com. And if you're there, just sign up for our free newsletter. Professor, it was really an honor, privilege. And
thank you, Kerry.
Great to talk to you. We'll definitely have you on again. Appreciate it.
Great.
Bye.
Yeah, we could talk some specific stock next time and get into some individual ideas. Or is it just the macro, if you like? Whatever you like, man.
I do. And I'll have a list of them for you. Thanks again for coming on.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.